Stock started the week on a very sour note, continuing the selling from late last week, really the last 3 days, with a little pause yesterday, but for the most part, post FOMC rally, it's been a sharp decline from that peak on Wednesday at the close, to the point where we are pretty sharply lower. So I'm going to talk about what the expectations are. They haven't changed from Friday's video. We talked about, you'll either gap down and rally, or, we'll close here at, significantly lower. Either way, it's the same, right? We're going to set the low point of the week here early in the week, and most likely rally through the middle, potentially toward all the way to the end of the week, and close more towards the high. So that's my expectation. I'll talk about how and why that's going to be the case in today's video, but I'm also going to talk about why this is not the low point. Like, we are hardly capitulating. There's a lot of chatter about capitulation. There's a lot of chatter about extreme sentiment. If you compare this selling to other years, which is what we do in the video, you'll see that this is hardly capitulation. There potentially is a lot more to go here. So we'll show you that. And then our trade idea is a stock that has been pretty bearish and potentially is setting a low point. So what can we do? There's probably a lot of stocks like that. So what can we do with them? So we'll talk about how to trade that. So let's go ahead and get started. Today is Monday, May the 9th, 2022. This is the market outlook from marketscholars.com. My name is David Settle. All right, well, let's start off taking a look at the S&P 500 with the market forecast indicator. As you can see, big decline, closing below, a lot of lows, closing below the lower shadows, which can act as support levels on both those days there. So pretty significant bearishness from that perspective. We did not finish with a cluster on Friday. We did finish with a cluster today. So, I mean, that's a pretty significant move. I've got the Fibonacci lines drawn on the current intermediate drop, as well as the current market sentiment decline that we've been on. The market sentiment, you can see now, has dropped back below 40 again. Never really did get back above it, even though we did get one intermediate run, but that was it. And it was a pretty strong intermediate rally. I mean, look, we went up. How many days in a row did we go up there? 1, 2, 3, 4, 5, 6, 7, 8, 9 out of 11 days. It's a pretty significant rally to the upside, but that was all we got. And so we've obviously reversed that and then some, down to a new near-term low point than what we had here the last time. So this is, you can see the last three peaks, 1, 2, and 3. So the lows in between would be this one here, in between that one, and then this one over here, the low point that preceded that little small near-term rally. So the same thing, we're forming another lower near-term peak coming off of a lower near-term high. We are 8.5 almost 8 2/3% below the 30-day moving average. That's lower than what we got over here. Now remember, this doesn't count the low, right? This counts the close. So we were way below it at the low point there. But by the lowest close was actually right there, we were 6 2/3. So now we're 8 2/3. In fact, you've got to go all the way back quite a ways here. Obviously the COVID drop, but even looking at COVID, you can see on the initial COVID decline where we really kind of hit the fan, we did get about this far down, got about 9.5, 10% below, and then we had that little short-term rally, some really big moves, a couple of big, really significant days. You can see here too, let me zoom out. In 2018, this was about as far down as we got. Ended up getting 11% on Christmas Eve. Going into Christmas Eve, you're about 9.25%. So there's that. You can see 2000 and so that was 2018. Let's go 2000 and early part of 2018. We didn't get anywhere close to that. 15 and 16 in 2015 here we got down to about 10% below the 30-day moving average, and then rallied really sharply, and then didn't get that close over there. Let's see, 2011. Let's go back a little bit further. In 2011, we got down there. You can see we were about 13% below at the low point. And you can see how big the up days were when we got that far down there. So needless to say, like, we got a cluster. We are significantly below the 30-day moving average. Dark pink shading again after this brief light green shading yesterday. Dark pink shading, red line. And you can see now, as we, because there will be, we're going to get some big up days, right? That's what happens when you're this far below. We've seen that. I just showed you examples. It doesn't mean that necessarily we start, like, we probably won't get 9 out of 11 up days, but we will move up towards what will be a really precipitously falling 30-day moving average. But now the problem is, instead of coming up towards like these areas here, 4,300 or whatever, you're most likely going to come right up to these 23% lines. This long-term one that's coming off the 2009 low, or excuse me, this is the COVID low. Excuse me, coming off that COVID low, and then this one coming. This is the market sentiment resistance level on this current market sentiment run. So we'll probably just come up to about 41.85 in that area, plus or minus 5-10 points or so, before we hit some resistance, because you got the 38% of this intermediate drop right above that, the 23% of the intermediate drop right below that. So kind of right in this area right here, you're going to meet up with some real, there's going to be that old low point there. You're going to have some pretty significant resistance there at that point. Looking at the NASDAQ 100, it's even worse, right? We are 12.25% below. Like, that's, again, COVID, even the initial surge of COVID didn't get this far below. So, and none of these other periods. So this is a pretty significant decline for the NASDAQ. I shared a tweet about how similar this was to 2018. So if I were to go back out to the fourth quarter of 2018, right there, we had dipped. We had multiple clusters. We had gotten to 11.5% below, so we're 12.25% below right now. 11.5% below the moving average. And you saw that we had a rally. That was the low point. Now at that point, the VIX, VIX to EM ratio, you'll see here in a minute, was 125%. We're not at 125% right now. And so you can also see too, if we activate these lines, the market sentiment drop that we're on, and then this intermediate drop that we're on. If we do fill in these gaps from this morning, because you expect that we will, right? You don't think that this is a common gap, so you expect that we'll fill that in. I don't think this is a breakaway gap or runaway. We'll come up towards this resistance level, towards 411. Assuming that we will at some point do that, let me bring up NASDAQ. You can see now that's where this old 38% retracement, that was a support level, now is going to be a resistance for us. And you can see also the 23% line of this current intermediate drop will be at that level too, and 23% line of this longer term market sentiment. So there's going to be some pretty significant resistance now in this 13,000 area, plus or minus 50 points or so. Now looking at the Russell 2000, you can see its decline, very significant decline too. With another cluster, its third cluster in this past little stretch. Move this down here. Again, you can see where its resistance is going to be. The 38% retracement line of that post-COVID rally, the 38% retracement of this intermediate drop, and the 23% of the market sentiment. So right here at about 1900 plus or minus 10, 15 points or so. So that's where your resistance is going to be there. And you are, again, 11% below, which is the lowest of the last year. It's obviously not going to be the lowest of the last 5 years because the COVID drop was lower. But if you take a look, again, this is lower than the initial drop right there of COVID, where we got to 10.5%. So just barely, pretty much about as low as we got there in multiple clusters. And we had that little brief. And that's the kind of rally I expect that we'll get here. It will be something like that. It won't change things, right? But again, you can see, 2018, we had multiple clusters when we got this far below. So like that was our last kind of normal correction, not the COVID, because that was such an atypical correction, but this was our last normal correction. By the time we got this far below, we were like racking up the oversold clusters that we're only getting a couple of now. But needless to say, we are very, very extended to the short term, which, like I said before, when you get these significant down moves, especially when you get them kind of back to back like this, you're going to get a significant up move, right? You're going to get a very significant up move to the upside, probably 3% or more, because we've gotten 2-3% drops or more in the last little bit. And you had this big sizable gap, which kind of exacerbates. And you can see the historical volatility right now is really, really high. In fact, it's pretty significantly high. Like again, you have to go back to see the historical volatility as high as this is. Like, it didn't get this high in COVID. It got about this high in COVID, not quite. Where are we at right now? Let's see. Let me show you. We are at 31.49 right there. 31.49 is where the current historical volatility is now. Back in 2018, fourth quarter of 2018. So right over here, you can see that we also got right about this level, but you notice it came after the implied volatility peaked. Neither one of these have peaked yet. It's kind of an interesting little pattern that we see. Let's take a look at the long-term charts, and you can see that we got a bearish candle. As of right now, we are closing below the prior week's low point. The PPO is falling. The PPO at 2.33%. Again, let's put that in some context. 2.33%. You can see where the fourth quarter 2018. You can see 15 and 16. So this is about as far as corrections get. Even again, going all the way back to when the last bear market, right over here, the correction that started, so you had the correction, then you failed the correction bounce before the bear market started. So on that initial correction, we got about 5% below there, and you can see that was about typical 2011, and so that's about where we're headed. Most likely, that's about where we're headed. You can see the candles are pretty big, relatively speaking, even going back all the way outside of the worst in the bear market, and then the COVID, where the candles really got big. That's what this is measuring down there at the bottom. Let's take a look at the 3 green arrow chart. We obviously have 3 red arrows again, dark, pink shading on all of these. We're in a bearish intermediate run, so that's very typical of a bearish intermediate run. When you look at where we are relative to these moving averages, we are significantly below 8 and 17. I mean, the MACD is the lowest it's been here in the past year. You can see the MACD there is at 1.9. Over here we were at 2.1, so that's why we're almost at the zero, the 0 percentile. But that's a pretty sharply lower MACD. Again, you go back and compare to other corrections and the initial surge of COVID, to just how bearish we are. If I were to change how far down below the 17-day the price is, this kind of gives you some context too. We are now, where is that value? 5.69. So we are now 5.69 points below. Let me follow that line. There's the initial drop for COVID, right? The initial drop for COVID got 8% below before we had that little surge off of the gap down. And we had that surge and filled in that gap there. If you come over here to 2018, that's how far we got at the end of it, much less the beginning, which again you would expect we're more towards the beginning than the end. So needless to say, lots of volume, and pretty sharply below these moving averages with some gaps that we need to fill in. All right, now let's take a look at some of these other oscillators here. And take a look at we are back above 30 and we're easily below 20, but you notice we're not like at extremes. In fact, the ADX here isn't even above 25. That kind of goes to show, like, from a trending standpoint, I mean, you look at how much we dropped from here to here and how long it took, and then how fast we've gone from here to here, and you see that reflected in the fact that the ADX just is nowhere near the same level. This has been a lot faster to the downside, which obviously anything faster like that is susceptible to just as fast of a move to the upside. We talk about that all the time. When you look at the Qs, I mean, the Qs aren't even above 30 on there, so kind of gives you an idea of the strength of the trend, right? The trend, as bullish as the trend is, it's not really as grinding as it is like right now, just kind of really dropping pretty. I mean, we're obviously below 40 on the RSI. We're well below minus 100 on the CCI. It's even worse on the ADX. We're below minus 180 on the ADX and well below 40 there, or 40 on the NDX, excuse me. When you look at the Ichimoku cloud, they're all showing very mature trends. SPY, IWM, QQQ, all very, very mature trends, well below the cloud. We've gotten to the green. Remember I told you, like, when we get to the green, we have to be above it if we're going to have any chance of like not being in more of a correction. Well, we got to the green and we are way below it. So, we are in correction mode. I mean, obviously we're below that 38% retracement support for the post-COVID rally. That's a pretty significant move to the downside, obviously, needless to say, right? I showed you this stochastics chart before in terms of how oversold we are. Like the SPX now is below the orange line for the SPX here on the stochastics, which is a 20-day average of this blue line, and the blue line is where we at right now relative to the 20-day range. I mean, we are below the 3rd percentile. You can see you don't stay down below the 3rd percentile or 5th percentile for very long. You tend to come right back up out of that. So, but if you notice now, the orange line is down there below the 20th percentile. I mean, we got down below the 20th percentile at the lowest of the COVID drop. And again, COVID was so unique. Very rare type of a pattern. You notice in 2018 we never did get below 20. We got to 20.6, but we never got below 20 on the orange line. Going back to 15 and 16, in the early part, right when it was almost over, we got down to 21.6. Never did get below 20. Going to 2011, there's 2012. We did get below a little bit more of a sustained drop. We did get, and we stayed down in that 4-week range. We did get below 20 there, and the same thing in June of 2012. And then, of course, there's our 2011. Before we hit the fan in 2011, we had gotten down there. But, I mean, we've had such a buy-the-dip mentality since then that every time this orange line pretty much dropped below 50, it was bought up without getting into that lower reversal zone, except for COVID, right? But anytime it just dropped in the middle, below the 50th percentile, we rallied. Well, now we are not just only below the 50th percentile, but we are below the 20th. I showed you already the Qs were down there. Now the Qs are below the 15th percentile, and then the Russell is there at the 16th. And you can see it does drop into more. It's a lot more volatile. The Russell is. The Russell 2000. If you look at where we are in these moving averages and go to the 5-year chart. The Russell 2000 has now, we've been expecting us, once you break the 50, to fill in the gap between the 50 and the 200. That's what a correction is. Well, look at the Russell. The Russell has done that, right? It broke it in the early part of this year and has now gone all the way down to the 200-week moving average. And you got your 50% retracement coming up here at 170, about another 5 points down. And there's going to be a shelf of volume there with your even more significant layer of support, probably worst case scenario, down here about 154 on IWM. To give you a sense, that's where the 62% retracement is. For SPY, there's the 62% retracement of the post-COVID rally. It's also the 38% retracement of the big the big rally off the March 2009 low point. So there was some significant support there. Again, we're way off of that level, and IWM is pretty far, but it's a lot closer, right? A lot closer. All right, now let's look at the intraday chart. So you see there's that gap, and so I expect that gap's going to get filled in here, and we might even fill in that gap up all the way up into that 430 area. But the reality is, like, in the very short term, I mean, just to kind of give you an idea where if we were to fill in this gap up to 411, where we are, again, remember when we get far away from the 8 and 17, we move up to the 8 and 17, right? There's 411. So 411 still wouldn't even get us to the 8-day moving average if we were to fill in that gap. If we were to go all the way up to 430, we'd be above we could get up to that 38% retracement level essentially and hit that resistance, but we'd be above the 17. The 17-day is going to be at this 421 area, and for some context in the short term where that is up into there. That's where the 4-week point of control is. But you can see there's going to be some resistance in the 4-week chart here with the volume levels. So very little volume down here. We're not below the value area. So it'd be very easy for us to move up. Remember, when you're in the value area, you tend to move towards the point of control. And so it'd be very easy to move towards that point of control there. Now here's the interesting part, is the VIX. So the VIX, rallied and we closed near the high of the day. But you notice we still have not closed above 100%, right? That's still fascinating. I showed you that chart on Friday's video, but if you were to go back here to again the 2000, so now we can go to Christmas Eve in 2018, right? Like right there, we finished today at 36. Today we finished at 34.75. So right there is where we finished today. And look, we finished at 125% on that day, and we cannot even get to 100% right now. Like that just goes to show again where VIX 3M is, right? And VIX 3M, which on the fourth quarter 2018 was also at a high point, but was at 28.84, and now we're at 35.05. So there's a lot more demand right now for longer dated options for protection, longer dated protection than what we saw at the worst. Remember, the VIX was about right here. Back then, the VIX was about right here, and you can see the difference, right? The difference between that level and this level. It's a dramatic difference, which again just goes to show that there's probably a pretty good probability that we're going to be bearish for a while. Now, it doesn't mean that we're going to be like tanking every day. Like, you're not going to tank 3% every single day. And remember, every time we do, we're going to rally 3%. So that's not going to be the case. You can see during this decline, when we're actually pretty bullish, we only fell 1%. Only fell 1%. We're going to have big moves. The volatility is high. We're going to have big moves. But the volatility is like the VIX, is not as high as really it should be. And if this is what it takes to get to 1%, remember, this is where we got to in fourth quarter 2018 at 125%. That was when we were capitulating, right? We are not capitulating here, and we're at 35. What's it going to take? Like at COVID, just to kind of give you an idea again with the COVID drop and where we were in COVID when the VIX got up to 34.75. I have to go back 3 years now to get the COVID drop. So where were we when we got up to 34.75? So we were right about in this area here. So we got to 39.16 February the 27th, and we were at 34.64. But look at that day where we closed. We closed at 130%. So we were, if we had closed that day at 34.75, we would have been at around 125%. And to kind of give you an idea of what it looked like here on this chart on February the 27th, and let's go back out. Let's go to this 5 year. Well, let's just keep it on the daily, but we'll go 5 years so we can see it. So here is February the 27th. So we had just barely gotten below the 200-day moving average, and we were like spiking in the VIX, spiking up to 39. This is similar where we're at now, but on a relative basis, we were way spiked. I mean, the VIX 3M was not rallying. We were way high because investors thought whatever selling we get is going to be very short term, and it was. It only lasted a couple more weeks. By 90 days, we were back to break even. 3 months later, we were back to break even. So there was a reason why there wasn't much demand for 3-month options, put protection. But now, see, interestingly enough, we are not just barely getting below the 200-day moving average. That would have been over here. 121 would have been the equivalent. Now we are that far below the 200. So if you were to kind of put it on this, so you can visualize how far below the 200 we are relative to where we were back then. We are 11% below the 200-day moving average right now. So by the time we got to 227, we were 2%. So we got to 11% way over here. We're 11% below was right in this area, March 11th of 2020. That was when we were 11% below the 200-day moving average. March 11th of 2020, right here, the VIX was at 54, and we're only at 34 right now. 54, and the VIX 3M was at 122%, and we had come down from some pretty significant highs. So it goes to show that the VIX is just not high right now, which means there still is plenty of demand going forward. So while in the very short term, we're extremely bearish and we're extremely oversold, 8% below cluster, right? And that typically leads to some kind of short-term rally. But from a longer-term perspective, 3 months from now, we will most likely be lower than we are here. At least that's what the VIX chart, the volatility chart, the ratio chart is telling us. We'll probably be lower than this. Why will be lower than this? Because what the options market is telling us is that we are most likely going to fill in that gap. And it's going to take time to fill in that gap. And we might go up and down, but over the next 3 months, so 3 months from now is August the 9th, that is right here. That is right here. By the time we get to here, we might be down towards 350. There's a very good chance we'll be. We might have already hit 350 and bounced and maybe retested into that area. But that's what the volatility charts are telling us, and that's pretty much what we should be expecting, especially considering that there's just no volume here. So what do you think? Do you agree with that assessment, both in the short term and the long term? Do you disagree? Let me know in the comments section below, especially if you disagree. What charts or indicators are you looking at that tell you why you're either a lot more bullish than I am or a lot more bearish than I am? Alright, before we look at some other charts, I invite you to subscribe to our YouTube channel. Mouse over this icon here in the bottom right corner of your screen. Hit the red subscribe button that pops out. There's also one down below the video if you're watching us on YouTube. That notifies you when our videos are posted. Also, while you're down there, hit that thumbs up icon. That tells us two things. One, you liked our video today. And two, you want us to do another video again tomorrow. It's a quick way to give us feedback if you like our stuff. Of course, if you don't like it, you don't have to click on anything. You don't even have to watch if you don't want to. Also, while you're down there, comment. What did you get out of the videos today? What stood out to you? What questions or comments do you have about anything I brought up today? Join our website at marketscholars.com. There's a link popping out up there in the top right corner of your screen. Click on that link to subscribe to our site for free. Follow me on Twitter for more content between the videos from day to day. There's my handle, at DavidSettle42. And join our Market Outlook Facebook group that we've created. All right, if you're watching here on our blog, check out some of these things over here on the right. Click on this Market Outlook Live icon. It takes you to this page. This is on Monday, Wednesday, and Friday at 3:30 Eastern Time. I do a live video on this page right here. It's about 10-15 minutes long. I take a look at all the trades we've done in prior Market Outlook videos. At the end, like the one you'll see today, the trade ideas. We talk about whether we should stay in them or get out of them. It's probably more important than just getting into one, what the trade idea actually is. Because anybody can tell you what trade to look at, but not a lot of people tell you how you should manage it or when you should get out of it. So we talk about that there. We also put on today's trade idea, like I said, before the market closed here. Again, you can get that also by coming up here and clicking on Live Trade Review. Come down here, you can see our upcoming classes. Click on View More. You can see all of our classes coming up for the rest of the month. You can go back and see 4 years worth of recordings on the calendar too. Come down to the bottom, click that heart. It opens up this tab. Well, it used to open up that tab. Here we go. What if you just open up this? There we go. So that takes you to, again, the current Market Outlook Live. Click on that like button, that heart right there. The same thing here. Click on that thumbs up icon. That takes you to this page. Click on that like button. Again, the more you do that, it helps get our content out to all of our followers because all the likes and retweets and comments that you have on replies. It also benefits you because Twitter and Facebook promote content in your timelines from the accounts that you engage with the most. So we try to make it really easy for you to engage with us right here. All right, when you look at this chart, you can kind of see, I mean, obviously we've been weak really since we hit that peak on March 29th. But from that peak there, you can see we really kind of accelerated in the last few days. If I were to come back over here to that March 29th low point, so we'll actually go March 30th, going forward from March 30th up until now. So there's the move. Then look at bonds. Like bonds are down just as much. In fact, the S&P is barely down more than bonds are. Emerging markets are down there too. They're down about, what, 13% or so. Real estate is down quite a bit. High-yield corporate bonds are down. Gold is down while the dollar is up sharply, up 5%. Commodities have started to come down the last few days. Really today more so than anything, but look at the Qs and IWM, both of them down to 20%, 17%. If I were to just look at today alone, big broad-based selling. I also told you that DBC has been doing really, really well, but when we're bearish, everything's dropping. Even in 2008, we were bearish. Commodities did drop. They just didn't drop as far as equities did, but they dropped when equities dropped, and then when they rallied up to new highs, whereas the S&P rallied up to, from below moving averages up to resistance at the moving averages. So that's the big difference. They still move in the same direction though, and so when we're risk off, we are risk off. And look at bonds. So bonds actually did way outperform today, more so than anybody. This was about as risk off pattern as we can get. And in fact, if you look at the ratio here look at these bonds, especially when you look at IEF relative to corporate bonds. So this is the 7 to 10 year relative to corporate bonds. And let's go back to a 1 year chart on this. And let's get back to the candlesticks. There we go. So here's the ratio chart. Look, this is risk off. Like IEF is really moving higher. The 8-day moving average is up above the 17. They both cross above the 50. The 30 is about to cross above the 50. They're both rising above the 50. And when you look at the high yield version of this chart, so IEI, which is the 3 to 7 year relative to the high yield, look at that chart. I mean, that's big time spike. Now, in the short term, that could be a really parabolic spike. So that could be a sign. You can see the MACD is about as high as it is. It could be a sign that we might be in the very short term kind of sold off. The other thing we look at, which has not peaked, or had not peaked until today, was high yield relative to investment grade. You can see it's been bullish this whole time since that March 30th, right? When the equities have been falling, this has been rising relative to investment grade. Not today. So high yield really got hit hard today. A lot of that's because of the energy sector, right? The energy sector has been pretty correlated with that high yield area. I mean, look at that drop. With commodities dropping as much as they did, high yield really got hammered big time. And again, when the markets are bearish, when we are in correction mode, true correction mode, everything drops. Bonds rallied, staples rallied, utilities rallied, relatively speaking, compared to everything else. And look at energy down 8% today. That energy sector had been so bullish. It had been so far above these moving averages. Now is down. I mean, we went from being well above the 8-day moving average on Friday to being below the 50-day moving average today. That's how much of a drop XLE is. Remember, when we get between these moving average, when we cross multiple moving averages at the same time, that's more bearish. In this case, we crossed pretty much all of them. And when you have such a large gap between two, you tend to fill that in. I expect that energy will start to fill in that gap, which, again, if I were to go back to, let's go back to that 2007, 2008 time frame, because remember, energy was so bullish in 2008. That's when the market peaked. So right here, energy was so bullish. The stock market, remember, was coming up against its 200-day moving average from below it and hit it and roll over. So during this correction here, this is when the S&P was in its correction. Energy was in a correction too, and it actually went well below its 200-day moving average. And if I were to show the weekly version of this chart, again, 2008, the S&P here in early 2008 was in a correction mode. Energy did come down below its 50-week moving average. Now it rallied back above it and eventually started its own correction later that year. But it got to its 50-week. I mean, look at this. We're still above the 8-week. So energy hasn't participated in just the correction with its own pullback, right? It doesn't have to come down to these low levels, but it generally will come at least down to that 30-week, if not the 50. Obviously would go through that if we were in full-on, once we're in bear market mode and everything is correcting. But now that energy has participated today, now I think, okay, the market has succumbed to the idea. Now it doesn't mean we're going to fall every day. So I just know that we don't fall 2%, 3% every single day. You will go down 3%, you'll rally 3%, and then you'll rally another day or two after that, and then you'll roll over and you'll go down more steady. So the next time we go down here, assuming we come back down to these levels, right? Assuming we bounce and we come back down here, the next time we come back down from wherever we end up bouncing to, let's say if we come back up to 420, if we were to come up to 420 and roll over, we would come back to 398 a lot more slowly. You can see how fast we dropped there, and then much longer it took there. How fast we dropped here, and how much longer it took to get down from that peak to here. We went really fast there. It took longer. So I expect the same thing, that we'll come up. Now, it doesn't mean that we'll grind. You'll still get big drops, but it won't happen in 3 days. It might happen in 6 or 7 days instead, to get back down to below 400 like we are right now on the S&P 500. And again, from a global standpoint, when we talk about when we're bearish, everything's bearish. Well, here is the, oops, not that chart. You can see Russia is off the table right now. But when you look at the 12 grid, for all these major economies out there, there is dark pink shading and a red line everywhere, right? Nothing is not, I mean, we got clusters. We got clusters in Brazil, we got clusters in Canada, we got clusters in Japan, we got clusters in India, in Italy, in Germany, multiple clusters in those two, multiple clusters in France. Like, we are well below moving averages everywhere. Emerging markets, developed markets, US markets, everywhere. Very clear sign, again, that this isn't just a pullback, that this is full-on correction, global correction now, which the last two global corrections, the US didn't participate in. So now we are in a global correction where the U.S. actually is participating. And I think that's why it seems like a bear market, because we didn't participate when everything else did last two times. Once from fall of 2018 to 2020, because the Qs kind of held things up, and then in 15 and 16. It was kind of a correction for us at the end of that. That was like full-on bearishness, right? You look at how these international equities have done. Let's go 20 years weekly chart. Then let's look at EFA first. So let's zoom out so we can get it. So there's your 15 and 16. We were in bearish market. We only got a correction in the U.S. and we didn't get it for a while. We corrected at the end of 14, and then we didn't start to correct until the end of 15 in the U.S. By then, the emerging markets developed markets were in their own bear market. Same thing in 2018. We got to bear market. We had corrected. We had gone down to bear market mode, and we really hit the fan with COVID. Really brought all these lines down there. Emerging markets, the same thing. Right? Emerging markets in 2014, we corrected. We were in a full-on bear market through 15 and 16 by the time we finally got above it in 17. And then in 18, we corrected hard before breaking down so far below the 200 that we got all these moving averages down. Again, you look at the U.S. markets, especially the NASDAQ 100, and you say, okay, well, in 15 and 16, we didn't come close to the 200 week. Neither did we in COVID either. So we were in bear markets in those international areas. We weren't here. But now we are. So now all of these major economies are all showing dark pink shading in the red line. Some, obviously to different degrees. That's why there's relative strength. In fact, when you look at this chart here and you say, okay, let's look at emerging. Well, let's look at VXUS relative to VTI. So global equities relative to U.S. equities. And you can see we're actually bullish. Like we have been trending down, but see how we're basing, and now we are above the 8-day moving average, which is above the 17, and they're both above the 30, and they're both crossing the 50. So we've been converging since really the end of last year. These moving averages have all been coming a lot closer to each other. The MACD has been rising. The PPO has been rising from these negative levels. So you would expect the international equities are really going to start to outpace. And if you were to zoom out on this chart, there's plenty of opportunity for international equities to outpace. They've been so bearish for so long. Even if you look at the weekly version of this and go out to 20 years and then change this PPO to the weekly version. So they've been so bearish for so long relative to U.S. equities that they're just now starting to turn higher here. And in fact, we're still below the 8-week. On a weekly basis, we still haven't really turned it around yet. We're just starting to, and there's plenty of opportunity for international to outpace U.S. because if you were to flip this around, U.S. is so extremely overvalued relative to international equities that there's opportunity to be bearish. So we just haven't been, except for a brief period in 2017 and 18 where U.S. equities did underperform, and we came back down to that 200-week The RSI was down below 50. You can see what the PPO was negative for the biggest. So that was really the only time that internationals outpaced U.S. equities. That happened to be one of the least volatile years for U.S. equities that we've had ever. The VIX was like below 10, and yet international equities were killing them. So that just couldn't, but they were coming off of a major bear market in 15 and 16 the U.S. equities didn't experience. So that's why they jumped up higher off of those lows, while the U.S. was just kind of grinding higher at really low volatility levels. All right, now let's take a look at our trade idea today. I want to take a look at UPS. UPS actually had a pretty decent day today, up more than 0.75%. You can see the near-term line, short-term line bouncing up. Again, we had a cluster. It was actually a lot more bullish. It pulled back at the close, even after our Market Outlook live video pulled back. But at the time, we had a really decent cluster above 2 candles. We finished with a cluster, or excuse me, an engulfing pattern with only 1 candle by the time we're done. But you can see we're moving back towards a 30-day, now less than 6% below, coming off of some pretty serious low points there. You can see from a weekly perspective, we had dropped pretty much, well below with very aggressively bearish short-term sentiment that had already started to rally last week because of that little spinning top, and is now rallying even more now, down 11% below, which outside again of COVID is pretty deeply below that 30-week moving average. You can also see some of these other oscillators like the DMI. We've been dropping, but we've been really converging as both these lines are like the positive directional index is moving higher, the negative is moving lower. You see that in the RSI and the CCI as well, right? They're not as, especially the RSI has been gradually moving higher while we've been dropping here, and the CCI you can see is moving up right now too, trying to get up above that 0 level. From a Bollinger bandwidth perspective, we had such a big bandwidth when we really dropped, but we've been consolidating enough. Even though we've been pointed lower, we've been consolidating with the bandwidth dropping to low levels, and we're at the, we're not nearly as bearish. In fact, we went below the lower band, which again, typically you either do at the beginning or at the end, which might suggest we might be at the end of this current leg lower to the downside. When you look at the weekly chart here on this chart, you can see how we've been pretty bearish. Like we got a bearish candle 2 weeks ago, pretty bearish candle last week on the Hakanyashi, very neutral. In fact, we might actually get a higher low point right now. We're just barely just a slightly lower, so very neutral candle with you can see the candles are getting smaller as we move up above its moving average. Essentially we're converging, right? We are converging on UPS. It's a bearish convergence. The MACD is above its moving average. We're still below the 8-day, much less the 17-day, but we're moving higher. All these averages are moving higher as we've been dropping. Again, suggests that we may be forming a low point. Here we are well below the 200-day moving average, but you can see we are in between the 50 and 200, and if I were to draw some Fibonacci lines from high to low, we're sitting right at the 38% retracement. So there is some Fibonacci support in this area where we're at. So there's an opportunity we might be able to bounce up here. So what I decided to do is come over here to UPS and do a bull put spread. And we did an at the money bull put spread, was at the money at the time, selling the 185, buying the 180. The nice thing about that is it allows us to, we put a half a position size on here. But the nice thing about that is I can risk the whole 490. I can because I'm trying to make 490, I can risk that whole, I can be willing to let this go all the way to maximum loss because that's what we're trying to make. But if it does rally to the upside, then, again, if I can get 50% of that really quickly, then I can get $250, boom, right off the bat before we get to 20 days expiration if we were to bounce off of this low point. Otherwise, I can get a pretty decent return for a short put vertical with a lot, more than what we normally get for half the risk of what we normally put on to get the vertical. So a little bit aggressive. It's not as high probability as your typical short put vertical spread, but it's a better, because it's so aggressive, this is a better way to manage the risk for a short put vertical spread that in this case would have a little bit lower probability. All right, well, that wraps us up for today. You've heard from me now, and I want to hear from you. Use that link that's popping out in the top right corner of your screen. That takes you to our Market Outlook forums. Open up any new thread with any questions or comments you have. Reply to anybody else's thread. Let's keep this conversation going in between videos. As always, thank you very much for watching. Remember to subscribe to our YouTube channel. Hit that thumbs up icon. Comment on the video down below. Have a great rest of your Monday night, everybody, and we'll see you all next time.